Biggs comment on the economic cycle and the outlook for 2019. I'd like to introduce a few of our staff here. With me today, obviously, you do know Steve. It's Carla McAvoy. She's another principal in the firm. She's back here. Jane Lang is our newest employee. She is diligently working on her certified financial planning certification. Gabe Walters just walked in. He has completed the study of his certified financial planning designation and is getting ready to take the CFP test. We also have with us Deanne Cardona and Jean Brusher. Deanne Cardona is our office manager and Jean Brusher is Deanne Cardona is our operations manager and Jean Brusher is our office manager. So welcome them when you see them. It's really my pleasure to introduce Steve Biggs. Steve's been a principal with the firm for 7 years. He is our chief investment officer and runs our investment team. And Steve is a CFA, which is a chartered financial analyst. He also has a master's in finance from San Diego State University, and he's been in the industry forever. He's had many jobs in the financial services industry, from the Montana State Pension Fund to Wells Capital Management, where he was a mutual fund manager. So without further ado, it's my pleasure to welcome Steve Biggs.
Thanks, Sandy, and hopefully we can get some loud enough sound on here. Hello? Should I just use this one? Okay, thanks everyone for coming this morning. And I don't know, did everyone watch the Super Bowl on Sunday between the Patriots and the Rams? So it's my hope, actually my expectation, that you should find this much more entertaining than you did Sunday. It's good to have the bar low. So we can all find this economics presentation very lively, hopefully. And also, I didn't think Andy mentioned it, we do have a new logo. So a little bit of a rebrand. You'll notice the new logo and the guy standing on the rocks. So that's, if you've been to our website, you'll notice a similar theme. So I just want to point that out. There we go. So kind of starting out with where we are right now in the economy, current conditions, and how things look.
Steve?
Yeah.
Could you hold this a little closer to your mouth?
Sure. And press the right direction. We're starting out like the Rams offense. Sorry about that. Okay, so this is gross domestic product. This is really a measure of how the economy is, where it's growing. So you can see in there, we're still running at a pretty good clip. 2018 was a great year for economic growth. I mean, we had a nice tailwind from the tax cuts that took effect the beginning of the year. We hit 4%, 4.2% in second quarter, which was probably about the peak. That fell off a little bit to about 3.4% in the third quarter. We're looking at probably fourth quarter around 2%. And, so slowing down for sure. Most economists looking at 2019 expect it to be somewhere in the 2% range. But that's still a pretty good growth rate. That's trend growth rate, meaning about what the economy can handle right now, is around 2%. So if we were growing at 4% like we were last year, the economy would probably overheat. We'd have to raise rates, and you know what happens, go into recession after that. So if we can grow at 2%, that's a pretty good number. That will certainly be enough to support corporate profits and employment, everything else. And that is what the forecast is right now for 2019. And what goes into that number is really the question. So how do we feel that the economy is going to grow at this rate? Well, we looked at leading economic indicators, and there's a number of economic data out there that you can find. There's a lot of noise, but there's some that really people look at that are a pretty good indication of where the economy is going, and what growth is going to look at. So right now, consumers are still feeling pretty good. leads to strong sales, spending. You know, if you feel good about yourself, the economy, your job, you're more likely to go out and spend money. So you can see this usually dips leading into a recession, and it's, you know, that's part of what causes a recession. They don't feel good, they don't spend money, that slows down the economy. You've had a nice expansion here, did turn down a little bit, and it certainly pulled back in the stock market late last year, would certainly have a negative impact. But overall, you know, these are still pretty good numbers. We certainly wouldn't say this is pointing to a dramatic slowdown in economic activity, consumer spending, or anything else. Something else called the leading economic indicators. So GDP is, when you get that, that's a trailing economic indicator. We knew how well the economy grew in the fourth quarter once we get it, but that was a while ago. There's coincidental indicators. That's supposed to give you a better picture of how the economy is now. Leading indicators look to the future and what the economy should do. So this is things like, you know, consumer sentiment goes into that, unemployment goes into that. Certainly if employment's higher, people are more likely to spend money. Manufacturing activity, so what we expect from manufacturing inventory levels, retail sales, all that goes in. You know, so right now, economic indicators look like they are still pretty strong. That we should still leading to good economic growth for the next year. You can see where they drop down. That's leading into a recession, and generally they turn back positive before we come back out. A lot of information on this chart, but really just if you looking at the colors. So this is the Purchasing Managers Index. And it's a indication of what manufacturing activity, which is really the core of most economies. So in this chart, the greens are positive, red is negative, you know, that yellow is neutral, so you know, light green is a little less positive, light red is a little less negative. So really what this indicates to you is that, you know, manufacturing activity has slowed a little bit from the peak back there, 17, 18. But it's still in expansionary territory. So purchasing managers, meaning they're purchasing materials for factories and they're going to continue to produce. I don't know if Tesla's in this picture or not, but apparently they're producing as much as they can, and that still looks pretty good. So, and this is also broken out by country. You see emerging markets a little more yellow, so a little not quite as strong as developed markets right now, but overall, globally, pretty strong growth. So the yield curve, you know, if you watch financial news, you hear a lot about the yield curve, and there's a lot of talk about inverted yield curves and all that. So this is the yield curve, and what it shows is short-term rates down there. That's generally controlled by the Fed. And then you come out, bottom axis there, axis is time. So it goes out to 30 years, and you expect rates to increase as you go further out. If you want to borrow money for 30 years, it should cost you more than if you want to borrow money for 1 year. So that is the normal situation. The red line there is where we were a year ago. So a normal looking curve, kind of, you know, lower rates for 1 year, and as you go out, they get higher. So that's a regular curve. The blue line is what we've got today. So that is much flatter than a normal curve. It's not quite inverted, but it's what's called flat. So the Fed controls those short-term rates. They control the overnight rate, the lending, you know, the Fed funds rate. That's what really drives those short-term interest rates. Longer-term interest rates are driven by market forces. So if people expect strong growth, they're bidding up those yields. People are taking money, buying stocks, risky assets, less demand for treasury bonds. If people expect a slowing economy, you know, rates are going to fall. So the longer term rates, the outlook has not changed all that much. We saw them go up pretty high mid-year, around 3%, over 3%, and then they've fallen back down. So kind of that forward outlook is about the same. The change here is really that the Fed has raised rates, and made that shorter term rate a little bit higher. And how this looks, so this chart is the 2-year minus 10-year Treasury. So if that's below 0, that means you've got a rate inversion. And this is one of the most important indicators that people look at for a recession, and is a recession coming. It has predicted every recession going back on this chart, which goes back about 50 years. It does sometimes falsely predict a recession. So we've had the yield curve invert without a recession. We've never had a recession without the yield curve inverting. So that is something that most people pay the most attention to. And right here we can see at the far right there, we're pretty close, but not inverted. So that's something that people are certainly looking at, but even once you get that inversion, you're still at least 6 months out. It's mostly going to be anywhere from 6 to 18 months out. So once we're still a ways from that, and even once you get that, it's you're still at least a year or so out from a recession. So that's certainly not indicating that a recession is imminent in 2019. Feel free to ask any questions as we go, too, please. The other thing we have, employment is very good. Is incredibly strong. This chart is from January 1st, but we just hit 4%, so it actually ticked up a little bit, and that was because there's more people entering the job force, so the participation rate has raised. So there's a lot of people working out there. It's about as good as it has been since the late 90s, for sure, and even just a little bit better on unemployment. We had high 3% range in the late 90s, and we know that was a very good time for the economy. We added 300,000 jobs in January. That's a really strong number. There's some indications that maybe in the most economically sensitive areas, that's been a little bit weaker, but still overall very strong. So that's certainly not a cause for concern there. The line on the bottom is wage growth, so still under control, about where you would hope to be. You're starting to see some. Before it was very light, but you're still seeing some. So employment, wage growth, both very good. And this is a chart. Now, some people, there's a couple well-regarded money managers, economists. Jeff Gundlach, this is one of his go-to charts for indication of a recession. And what it is the unemployment rate, the current unemployment rate, and the 12-month moving average of the unemployment rate. So it really is an indicator of employment momentum. And this chart, all I had data as far as 25 years, that's all I can pull in. But we crossed there in March of 2001. The recession was, January, the recession was March. Crossed there again, I lost my data label. But again, that was about a 6-month lead time till we actually went into a recession. So you could probably blow this up a little bit, but if you can see, those lines are still not touching. There's still a little gap there. So these are kind of clear crosses on the moving average versus the current. So that is another thing that shows no average or no alarm. You had a question?
Steve, on those 300,000 jobs in January, you know how many of those in the private sector?
I think they were most, not the exact number, but it was heavily private sector. There's some, obviously with the government shutdown and everything, there's probably some distortions in there. But primarily all this job growth has been private sector. The government's been pretty minimal. So the other thing we look at, right? So that's the economy. It doesn't really show that a recession is coming or imminent or anything like that, at least not in 2019. It does show that we're late in the economic cycle, late in the business cycle. So we've got almost full employment. We've got that flattening yield curve. I think you'd see a lot of things are running at pretty close to full capacity. Not a lot of inflation, but we're pretty full capacity. So late in the business cycle. The other question is, where are stocks? So this is a chart that shows the price earnings multiple, which is kind of there's many ways to do valuations. This is kind of the big, broadest approach that most people at least look at, certainly the easiest to use. And this is looking at forward earnings. So this is what the stock market, and by market we mean right here the S&P 500, what is trading at on 2019 estimated earnings. And that average has been running in the 16 range over the past, for this chart goes back to 94, so about 25 years. And you see it got expensive in the dot-com bubble, it got cheap in the financial crisis. So where we're at now is around 14. Now this is January 1st, so the market's up about 7 or 8% since then. So not as cheap, but it is certainly below the average. So it's hard to say that stocks are actually expensive right now. We've had a 10-year bull market, a little bit of jeopardy there at the end of last year, but still we've had a nice run for stocks, and they don't look that expensive. And so there's two reasons for that. One, stock prices sold off, so that brought the price down. And then you've got the earnings, and you had 23% earnings growth last year. A lot of that was due to the tax cuts, which were one time. We're not going to get another tax cut this year, so that's not going to repeat. But you did have revenue growth, and once those are in the numbers, that should be the tax rate we expect going forward. So that is some cushion for the stock market. It's hard to make a case that stocks are overvalued on most metrics. Volatility. So you may have noticed last year, unlike 2017, we got a little more volatility in the stock market. So this is what's called the VIX, the volatility index. It measures the volatility of the S&P 500. So volatility can increase, when stocks move a lot. That tends to be when they move down. We're not so worried about rapid move up, but they don't tend to move up as quickly. They move down very quickly. So that's why we get those spikes in volatility. 2019 or 2018, you see, we had January was a real good month. Whatever month I was here doing this last year, we had a really good start to the year, and then things fell apart. A lot of discussion about trade was really kind of tipped the market off, and we had a pretty good correction into February and March. Things stabilized the middle of the year. Q2 and 3 hit some new highs, and then in Q4 again we had another big sell-off. So that's coming on the heels of 2017, and you can see 2017 stands out as a very non-volatile year. So you had just a nice steady move up in stocks, no real corrections, sell-offs, anything like that. That was a very unusual year. So if we go back further than that, they look a little closer to 2018 than 2017. So that's more the norm, and it's also more the norm later in the cycle because people are starting to focus on other risks like interest rates and economic data, where middle of the cycle, people are less worried about that stuff. You're just looking at economic data and hoping it's improving, and you're not so sensitive to all these other little details. So that is probably likely to stay. We've also got, we'll cover the risk later, but that's probably, we expect more volatility, more things like 2018, hopefully not quite as volatile as 2018, but just be prepared that there's probably going to be a little more volatility as we go through the next year or so. So overall, we're still in expansion. There's no indication that a recession is imminent or anywhere near. There are occasional data points that come across to say, hey, we get a big tick down in factory activity or economic activity, So you can always find some data points that are negative, but the ones that people really look at that have been predictable indicators of a recession really show that it's not that imminent. It doesn't look like 2019 will be that year. Most economists, the consensus is 2019 is another year of growth for the economy, pushing it back to 2020, probably a higher than expected average, but that's mostly just because people don't see it happening in 2019, and we do know we're late in the cycle. So consensus really is 2019 should be pretty good for the economy, and 2020, maybe we'll have a recession there. So that being said, the economy looks good. What could possibly go wrong? Well, there are some risks. So this is Jay Powell. For those of you not familiar with the new Fed chair, the market is always watching the Fed as at late stages in the economic cycle and the expansion, because we're really worried about inflation. We're really worried about interest rates. Stocks are afraid of interest rates because, one, it gives you it gives you an alternative to stocks. I mean, if bonds look attractive, you can just buy a bond and risk-free, or you can buy a corporate bond. The other thing is some companies, it cuts into margins and things like that. So the Fed has been tightening. Typically rising rates indicate a good economy, and that should be a positive for stocks. There's a term on trading desks, don't fight the Fed. That means that there's a lot of sectors that do up pretty well during tightening cycles. So, even though it causes increased volatility, don't get too nervous, and focus on the fundamentals and buy cyclical stocks. So the Fed mandate originally was stabilize inflation and keep unemployment low. What we've seen seep into that is stabilize asset prices, and that goes back to the Alan Greenspan era. They were very cautious about raising rates. They didn't want to spook the markets. So there's some that say that led to an artificially low interest rate environment, also known as the Greenspan put. You could always count on the Fed to bail you out if you were long stocks. So Jay Powell, we don't know about that. That kind of continued. We don't know about Jay Powell. Or Jerome Powell, however he likes to be called. I don't know. But we are still historically low, and he has seemed a little more aggressive on raising rates and a little less concerned about what the stock market thinks. I hear he's a former hedge fund manager at one point, so he certainly has a pretty good idea of what the impact's going to be. He's not naive to markets. So he has changed his tune a little bit. October 3rd, he says, we are, right after raising rates, he said, we're a long way from neutral, which neutral meaning, a level of interest rates where it's not hurting the economy, but it's not driving the economy. So the Fed really would like to get to a neutral rate, because then when we have a recession, you have room to cut rates and stimulate the economy again. So he said a long way from neutral. The next time he came out, November 28th, they did not raise rates. He said, well, it might almost be at neutral. And then they raised them again in December and came back again in January and said, the case for raising rates has weakened somewhat. So the Fed right now appears that they're going to be a little more cautious in raising rates. That being said, the market has maybe overestimated that level, and I think they really are going to look at economic data. I don't think they're going to completely focus on the market. So this is the interest rate curve. That's the Fed funds rate, and basically short-term interest rates. So you see private expansions. Fed rates are much higher. They've zero for a long time after the financial crisis. Started to bring them up. The lower line there, so the top line is what the Fed is saying. They were kind of indicating 2 more hikes. Now they're saying, more data dependent. We'll see what it requires. Market is down there, so that's what the futures market is pricing in to as far as expected rates, and that's none, even maybe a cut coming next. So I think it's going to be data dependent. I think that the market it might be underestimating the Fed's willingness to raise rates at this point, given what they've said lately. So that could cause a little bit more turbulence. I would not say raising interest rates, because economic data is necessarily a risk. I would actually be more concerned if the next move is a cut, because data is weak. So it's but that's certainly another additional brings on volatility. The other part of the Fed is the Fed's balance sheet, which you may have heard about. So my grays don't show up that well, but there was a recession right here in 2008. And that is the Fed's balance sheet, basically how much they own in bonds. So if you remember 2009, they came out and said they cut rates to zero, and they still wanted a way to stimulate the economy. So they wanted to loosen monetary policy further out on that yield curve. So they wanted to bring down the 5-year rate and the 10-year rate. So they went out and started buying bonds, and to hopefully drive down interest rates. They did that 3 times. It's called quantitative easing, and they ended up with about $2.5 trillion in bonds. Never been tried before. So there's still a lot of debate about whether it made a difference or not on interest rates, or whether $2.5 trillion is not really enough to make a difference based on the full bond market. Maybe it's just too small a piece. So there's a little bit of debate on that. However, now they're starting to unwind that. This is whatever impact it had on the stimulus, this is tightening. So they're actually putting more bonds out into the market, or letting them mature and not buying them back. So this is kind of the unknown. There's certainly plenty of people that think that didn't make a difference on when they were doing the easing, so tightening is not going to make a difference. There's a lot of people that think it will. It adds a little bit of a wild card into the situation, because it is essentially tightening. So they are slowing down the economy in this way. It's just no one really knows what the full impact is. So something to keep an eye on. And then trade. Now, trade realistically is probably the biggest risk that I see to the economy right now. And it is also maybe the hardest to predict, because I'm not there. I'm not doing the negotiations. I'm not in charge. It kind of comes down to, what these negotiators decide to do, and, what the leadership decides is good. So so that's really the biggest, it's hardest to predict, and probably the biggest individual risk. These are some of the dates that we've had, and a lot of them coincide with a lot of the market turbulence that we've seen over the last second half of the year. Really, once those trade tariffs were started to be enacted, really around August, late September 24th, kind of stands out on there as the third round of tariffs by the U.S., and China implemented some tariffs of their own. They are, currently in negotiation. I think March 29th is the deadline for coming up with some kind of agreement before the next round of 25% tariffs get enacted. So the question is, what has it done to trade? Well, this is interesting. We've actually increased imports, decreased exports. So the deficit has increased since this was implemented. However, a lot of that was probably a rush to buy things from China, bring things in, steel or whatever. So that's one time. And actually, I saw a release this morning, November's data, and that import number had dropped quite a bit. The other thing, what we're exporting is that soybeans mostly to China. So they can buy those elsewhere, not as easily, but it's possible. So exports are continuing to fall. That certainly should be expected. So the trade deficit, I think, did actually fall a little bit in November, just because not because we are actually exporting anymore. It's just that we're importing less. Probably just a little bit of inventory build going into the tariffs. So, finishing up on trade, just to point out, I mean, the couple surveys, Atlanta Fed surveys found so far only a small negative effect on U.S. business investment to date. And Goldman Sachs did a survey of companies planning on investing, basically investing in plant and equipment. And so far, it hasn't seemed to make a big difference, so that's fairly encouraging. Whether the next round would make a bigger difference, we don't know, but at least it hasn't had a huge impact lately. Hiring certainly hasn't seemed to be impacted so far. The share of industry employment supported by exports has not seen a deceleration in job growth. If we look at companies, as far as the stock performance, it's hurt companies that export a lot to China, and it's certainly hurt Chinese companies that even more that import a lot to the U.S. So that's where we're at now. The bigger risk out of this might actually be what it does to China's economy. So this is Chinese growth, and the world's all tied together. China's a big economy. If they slow down, we're going to feel it, of course. So China's slowing down from a very high growth rate. Last year was about 2.7%. That's looking at looks like it's going to slow to about 2.4%. So what we really, not that far, 6.4%. Yeah. China goes to 2.4%, we're in trouble. So, so China's becoming a stronger economy. It's becoming more consumer driven. You see those big growth rates. That was government investment. That's not sustainable. So the good news for China is it's becoming more a consumer-led economy. It's really more of a developed market anymore than it is an emerging market. So it's going to be less volatile. So that's positive. It's not as export focused. So just not exporting should not hurt them as much as it would have, say, 10 years ago. But they are going to feel it. It's slowing down a little bit. The other risk is that they have a lot of debt right now, so a major slowdown could certainly disrupt the Chinese economy. Barry, you got a question?
One of the things I sense that has happened this last 10 years in the growth of the market, which is unique versus previous years, was the growth of the middle class globally. I mean, that did not, correct me if I'm wrong, obviously, that wasn't too impactful prior to 10 years ago. And it appears to be very impactful now. How do we track that? Or do you agree that it affects our market or doesn't affect our market?
Yeah, I think it's a big impact on our market and companies, U.S.-based companies, because they like a lot of U.S. goods. So how do you track it? I mean, I think the World Bank tracks that stuff at percentage of the world in the middle, what's considered middle class, and that's increased a lot over the last decade, and it's forecast to grow much higher. So, as far as investment opportunities, that what we look in portfolios or individual stocks, that's certainly something we're looking at is what's this company's exposure to China. And right now, is Nike, Apple, Starbucks, Estee Lauder all have pretty good exposure to China. So it's a risk for those companies. They've been moving up and down quite a bit with some of this, but there doesn't seem to be a backlash really against them, and it hasn't seemed to have a big impact so far. But I think the longer term thesis, regardless of whether China slows here, is that is going to be a major economic driver over the next 20 years or so as more people move into the middle class, and that's China, that's India, and hopefully other countries as well. The other risk here, Brexit. And it may be more of a risk because there's so much else going on, people aren't really looking at Brexit as much. So they have made some, in a way they've made no progress, but in some ways they have made some progress. So, last month, they voted on a plan and that got turned down. There's a few different amendments that got voted on there. So, some of the sticking points is still over the Northern Ireland border and what happens there. They did pass an amendment that seeks to avoid a no-deal Brexit. So no deal meaning They have no idea what they're going to do. There's no trade agreements in place with Europe or anywhere else, and they're just on their own. And that would certainly be very disruptive to the global economy. The UK is not a huge country, but it is big enough that it would certainly have an impact. So it's something to keep an eye on. It does look now that they're not going to have a deal figured out, but that they will probably delay it. So most people are expecting, the most likely case is a delay, possibly no Brexit at all. And then what they call a no-deal Brexit would be the least likely opportunity, least likely chance. So hopefully that's correct. But certainly it does pose a risk to the global economy, and something we're keeping an eye on. Yeah.
Has anybody done any modeling on if nation assert their sort of national sort of borders more assertively globally? If there was a global trend in that regard, has anybody done any modeling to see like that actually increase corporate profits, or like the bottom line for corporations?
Well, yeah, there's models out there. Obviously, we've seen kind of shift to more nationalism. See here in the UK, they put together trade models and how the impacts on that. Individual companies are going to generally benefit from having free trade, even though maybe the U.S. steel industry would benefit from steel tariffs. Just as a whole, is simply going to benefit from the lowest impediments to trade. And I would say, the tariff levels we're talking about, the models really don't show a big impact. So that is somewhat comforting. But I would say, they're models. They're not, there's weather models too. They're not always accurate. And, things can, so it's still a risk. I don't think, subprime mortgage models in 2007 showed the impact that they would have. And what we didn't understand was that it wasn't just one subprime mortgage, it was leveraged like 10 times and invested in, so it infiltrated the whole system. So anytime you're tipping things out of balance, it'd be a little cautious, even if the models say, it shouldn't be so bad. So yeah, so I would also point out that the models do say that the tariff levels they're talking about don't indicate a dramatic hit to the economy. A drag, but not a complete disaster. So that kind of in summary is the economy is still growing. We don't see a recession in 2019. There are some risks which could cause things to change, right? So if you get a major shock, that could cause something to change that we don't see here in the economic models. And so why do you still want to own stocks? Is because we know we're late in the cycle. We know at some point we'll have a recession. And this just kind of shows that some of the best returns actually come at the end of the cycle. So people will get more excited. You're not looking at the same thing I am. There we go. So that middle line is the peak. So 24 months, the last 24 months of the expansion. Historically, stocks have gone up over 40% the last year, still around 23%. And then past the cycle, they tend to recover fairly quickly. So yes, you could try to time the market and say, hey, time to get out. We're 8 years into an expansion, but that's an important part of the return. And, if you're, as far as a long-term strategic decision, it doesn't make sense to try and miss that one sell-off or that one bear market, because you're losing the return going in, and then you don't really know when to get back in. So it's more of a strategic asset allocation and how much you feel comfortable having in risk assets versus, say, bonds, which show very little return, but of course very stable. And looking to get back in. The bottom of the last bear market was March 9th, 2009. Really, there's really no indication that, hey, March 9th, 2009, it's not like everything looked great. It was not standing around like, wow, this economy looks really good. It's there was just no more bad news that could come out that would really, everyone was so pessimistic, no bad news would really hurt anything. Jen, did you have a?
So just the bar on the far right, the -1, so that just means that 2 years after something like this, you're not losing money anymore, but it's not that the returns have returned to their previous levels, it's just, you're not losing any money.
Yeah, on average, so about 2 years after the bear market starts, you're back to where you were. So yeah, and I've got a chart in here for the last bear market too, which kind of shows some of the numbers. Which the last bear market was a bad one. Certainly, that doesn't include. I mean, that does include 2008, but that's just one data point. So, on average, about 2 years. This shows portfolios over different time periods. So the first on the left there is 1 year period, and you could have a really good year in stocks at plus 47%, or you could lose 39%. If you mix bonds in there, you're going to be a little less volatile. But here, when you get out to the 5-year and 10-year numbers, really even just going out 5 years, that narrows that range of returns in stocks from -3 to 28%, and then if you mix in bonds, do a 60-40% portfolio. You're really kind of tightening that range to a pretty healthy, expectation. So, it really kind of pays to stay invested, and I think the next chart, she shows that a little bit better. You see that? The top chart there this is the 2008 recession. So if you were in all stocks, you're in this green line, you lost 50%, which certainly wasn't good. And then, before March 09, and then took you 3 years to catch back up. That light blue line is 60-40 portfolio, 60% stocks, 40% bonds, and you were back to even after about 2 years. So, having a diversified portfolio doesn't always seem like the best thing to do when stocks are going up. But over the long term, it all works out. And even if you were all stocks, all S&P 500, you didn't get ahead, until about 2016, that is, you were still about where you're at with a balanced portfolio. Had you started with that at the last peak, then you start to lose a little bit of ground, and then that last sell-off, you're kind of back to normal. So that's why you might be, you probably are giving up a little bit of return to have a balanced portfolio, but the risk reduction is, for most people, certainly worth giving up that extra return. So the other interesting thing here is, a lot of individuals like to jump in and out of the stock market. Ideally, we'd all like to sell at the top and buy back in at the bottom. Unfortunately, that's harder said than done, and this shows returns of different asset classes. S&P 500 right here, 7.2% over the last 20 years. Obviously, we had, and that includes 2 pretty bad bear markets, down 50% or so. Still returned 7.2%. We got REITs and gold did a little better, 60-40% portfolio, around 6.4%. That orange bar at the end, 2.4%, that's the average investor. So JP Morgan comes up with these averages by using fund flows to see when investors are getting, mutual fund flows to see when investors are getting in and out of stocks versus bonds. So that's the number they came out with. If the average person trying to jump in and out kind of runs around 2.4%. So that's why I like to stay invested. So in conclusion, the economy is slowing from the pace of growth we've seen, but it's not over yet. 2019 GDP growth should be close to the sustainable average, or